What's good on my stock market homies? It's your boy Kevin. We got a big one today. We got a doozy. In today's video, we're going to be talking about the top 3 mistakes that retail stock market investors like me and you make that end up costing us tons of money and tons of profit. These are mistakes that can be avoided. And if these mistakes are avoided, it will end up making you a more profitable investor. We're going to go through them one by one, talking about what they are and how we can avoid them. Before we get started though, everybody do me the favor of destroying the like button. The like button is not our friend and we must destroy it. Let's jump into the charts and we'll go through these mistakes that we should be looking to avoid. Mistake number 1, I got the Tesla chart pulled up on the screen. Mistake number 1 is buying into a stock one time and thinking it's going to make you rich. Sure, there are stories out there of guys investing a few $1,000s into a stock and they hit the lottery and the stock ends up making them wealthy. That is very, very, very rare. You're probably better off just going and buying lottery tickets if you're looking to do that. If you're looking to turn a little bit of money into millions of dollars, you're better off buying the lottery. The way wealth is generated in the stock market is building into positions and growing your portfolio over time. For example, let me clear the drawings on this chart and I'll show you a pretty significant example of how this can happen. All right, so Tesla, we all know that it's been very strong. I know people who bought Tesla years ago and still lost money. It's hard to think about, it's hard to believe, but it can happen and I'll show you how it does happen. Let's say you bought Tesla way back here at $194 a share. That is a great deal, right? Everybody wishes today that they could have bought Tesla for less than $200 a share. But let's say you put $5,000 into Tesla way back there at $200 a share. It dropped by 61%. Even though Tesla is up huge, if you bought way back here one time and never built and added to your position, it dropped 61%. You sold at the lows and you ended up losing money even though Tesla rocket shipped to the moon over the coming years. If you had just held and added to your position, you would be up at the highs more than 715%. So that is a prime example of the cost average down strategy, right? Let's say you have $5,000 to start with, okay? So you put $5,000 in right there at, call it $200 a share. It drops for $150. You put in some more money, it drops all the way down to $100. You put in some more money. That takes your cost average from $200 a share all the way down to $150 a share. Then Tesla rocket ships to the moon. You have a really nice cost average. You didn't panic out of your position and you added on the way down. And now you're sitting pretty when Tesla's on the moon. Another example showing how important it is to add to your account over time is this compound interest calculator. This compound interest calculator shows you how a garbage man, a teacher, people with average jobs, construction workers, guys who don't make too much money can still become wealthy, millionaires from investing small amounts of money in the stock market. For example, let's say you start with $5,000. You keep it in the stock market for 30 years. You don't add any more money, okay? After 30 years, you only have $87,000. But let's say you're a garbage man, you have $5,000 you want to start with, and you can add, let's say you can add $500 a month to your portfolio. You still get that interest rate of 10% annually. Then let's see what it turns into, more than $1 million. That is why adding to your position slowly over time will help build that wealth that you're looking for. If you're trying to hit the lottery, go to the gas station and buy some scratch-offs, you have a better chance. But if you're trying to build wealth from investing in the stock market, pick a group of stocks you like, put an initial amount into them, and then slowly build it. Add every single week, every single month, whatever you can afford to put in the stock market. Most people say put 10% of your take-home pay into the stock market. And I agree, I think that's a good number. So if you make $3,000 a month take home, you should be putting $300 into the stock market every single month. It will build and snowball over time. That's obviously not financial advice, so contact your financial advisor. That's just how I look at it. Mistake number 2 is going to be chasing the hype, chasing the FOMO. That means you hear everybody talking about a stock. It's all over social media. Every YouTuber's talking about it, all over Twitter, all over CNBC, but it's up 100%. And you want to be involved. You don't want to be left the only guy not invested in this company. And so you buy. Even though it's up huge, you buy. A great example of this is Hyliion, my favorite stock in the entire market. I love the long-term outlook of hybrid. I think hybrid is a sleeper technology. But let's look at this chart. If you had given into the hype and bought way up here at $40 a share and never taken any profit on this run up, you would be down huge. Why? You gave into the hype. You gave into the FOMO. The much better strategy, the strategy that I used, is when it started to drop, I took a starter position and then it continued to drop. I added to my position and then I started adding way heavy way down here. I started buying up above $20 a share, but I got my cost average down to $11.86. I absolutely love that price, and I was able to do so by staying away from the FOMO over here and then adding into the drops. I think that is important. Stay away from the FOMO, add into pullbacks, and build that position around a lower cost average. That will help you to become an exponentially more profitable investor. Mistake number 3, not knowing whether you're an investor or a trader. That is a big difference. Are you trading these stocks, swing trading these stocks, or are you looking to invest in these stocks long term? You absolutely need to know what you're trying to do. Let's jump back to the charts and I'll show you an example. If you were a trader, it may not be a bad idea to take a position right here. You're looking for the breakout, it breaks out, and then you sell. But you know you're a trader. You know you have to be in and out. If you're an investor, it's maybe a better time to wait for the drop and buy the dip. But you always need to know, are you looking before you pull the trigger? Before you hit that buy button, you need to know, you need to have a plan. If your plan is to swing trade, you need to have a buy zone. Let's say your buy zone's right here. You need to have a stop loss, and you need to have your profit target in mind before you hit that buy button. If you are a long-term investor, I think it's great to have a profit target. You need to have a profit target. If you're buying at 30, you need to have a profit target. Maybe it's 60, maybe it's 70. If you're buying at 30, you also need to know where you're going to add, where are your add zones. If your first buy is at 30, maybe your second buy is at 25, your third buy is at 20. So swing trading, you need to know your buy zone, your stop loss, and your profit target. If you're a long-term investing, you need to know your buy zone, your profit target, and your add spots. Too many times I see new investors buying stocks and they don't know what they're doing. They don't know whether they're swing trading or they're investing in them long term. So that's mistake number 3, not knowing whether you're swing trading or investing. All right, I want to talk about one more bonus mistake, and that is investing long term and letting the price action dictate your sell spots. That should never be the case. Let's say you bought Hyliion back here at $32 a share and it dropped all the way down to 18 and you sold. That would absolutely be a mistake in my opinion. Why? Because nothing has changed fundamentally. The only way I'm selling a stock for a loss if there is a change fundamentally in the company. For example, if I own Tesla stock and it dropped 100%, it was going to zero, I would still not sell if there was no negative changes in the company from a fundamental standpoint. However, if Tesla stock was going up and I had invested in Tesla because I like the long-term outlook of their solar business and Elon Musk came out and said, we're no longer getting in the solar space, then even though Tesla stock was going up, there was a change that I did not like in the company, so I need to exit. From a upside perspective, price target perspective, the only time I sell a stock from a long-term investment standpoint is if it hits my price target. I don't care. Everything else is just noise. I don't sell if I'm down unless something has changed fundamentally, and I don't sell if I'm up unless it hits my price target. Those are the biggest mistakes that I think new investors and traders are making in the market that is costing them tons of money. I love to see new investors get involved. I think brokers like Webull, 2 free stocks, link in the description, $1,850 of free money, so check that out. And Robinhood have done absolutely great things getting younger millennials investing in the stock market. I think it's great, but I see a ton of mistakes being made. So hopefully this video helped at least one person stop making some of these mistakes. If it did, this video served its purpose. If you got something of value from it, do me a favor and hit that like button. Consider subscribing to the channel. I love you guys, and I'll see you in the next one. Until next time, peace.
Drop.